What is up, everyone? Welcome to Investing Club. In this video, I'm going to be talking about 3 ETFs that I think have a very good chance at outperforming the S&P 500 over the next 5 to 10 years. And this is just my opinion based on the trends I am seeing and should not be considered financial advice since I am not a financial advisor. And I'm going to go through these 3 ETFs and talk about why I think they will outperform the S&P 500. I personally don't own any of these, but I may start a position in one of these in the future. So let's get started. And the first one is the Spider China ETF. The ticker is GXC. And this ETF tracks the China stock market. And you can say whatever you want about China, good or bad, but the truth is that the economy in China is about to explode. They have a population that's 4 times bigger than the United States. They have a massive population. There are new businesses being created there every day. And whether you like it or not, China is going to surpass America at some point to become the economic superpower of the world. It's going to happen at some point. We can take a look at this image, and it shows that by around 2030, China is going to pass the US in GDP. So in the long term, I'm very bullish on China. I think investing in a China index fund could potentially provide you with very good returns. And the stock market in China right now really reminds me of the United States back in the 1960s and 1970s, where it was in the early stages of the explosion of growth we saw in the last 50 years for the United States. And I think that has the potential to happen in China right now. And we all know what happened in the US stock market from 1960 to now. It just went straight up, probably thousands of percent. And so I think that has the potential to happen in China too with their economy. This ETF reached a high in 2017 and it's sort of been consolidating since then. Very soon, I'm expecting it to break out and go to new all-time highs as the economy in China starts to really take off. All right, so the next ETF that I think can outperform the market in the next 5 to 10 years is an ETF with the ticker ZIG. And this ETF is called the Acquirers Fund, and they are managed by a famous investor named Tobias Carslile, and he wrote the book Deep Value, which is a very good read, and he is a well-known value investor. And we can take a look at the top 10 holdings, and these are all value stocks. These are all stocks that the fund manager thinks are undervalued. And I've spoken about value versus growth investing. Watch my video, I'll put a card up to it right now, about value versus growth and how I think value will vastly outperform growth investing over the next 5 to 10 years. I'll put the image up that I had in that video where we've seen growth massively outperform over the past 10 years, but I think there's about to be a shift, and I think we're going to see value perform very well compared to growth stocks. And so if you think that, like I do, then the place you want to be is value stocks, and that's what this ETF does. It is a portfolio of undervalued stocks based on their financial metrics. And if we do see a comeback in value stocks, this ETF will do very well. All right, and the third ETF on this list is the Regional Banking ETF. The ticker is KRE, and this is one I've talked about before. I see a huge opportunity in small cap regional banks right now, just based on the valuations they're trading at. If we take a look at this ETF, the price to book ratio is currently a 0.85. And I've said in past videos, banks are usually valued based on their tangible book value. And so their price to tangible book value is going to be even less, and that's already a huge discount baked into these small cap banks. And if we just see them return to the mean valuation, that is a huge appreciation and value for this group of companies. Now, regional banks may be risky, especially now where it's really unclear where the economy is headed. We could see a number of smaller banks really struggle in the coming years. And so that's why I think it would be a good idea to hold an ETF like this where you hold a basket of them. So even if a few do poorly, a recovery in the economy will result in a very large increase for the ones that manage to do well. And this ETF has a dividend yield of 3.4% currently, and their PE ratio is under a 7. So this is a very cheaply valued ETF right now, and these bank stocks are growing at a pretty fast rate. Small cap banks tend to be pretty fast growers. So in my opinion, I think this is a very good opportunity to get into the small cap banking index. I've also talked about how I really expect interest rates to begin to rise again in the next 2 to 3 years. I'll put up the chart to long-term interest rates, and based on history, they're going to go up at some point. I don't know when exactly that's going to be. It seems like they're going to stay at 0 for the foreseeable future, but eventually they will start creeping up. And while that is a bad thing for the rest of the stock market, for banks, that's actually good because it'll allow them to make more money on the spread of their loans. So that's just another reason it's a hedge against the inevitable raising of interest rates, and that's why I really like bank stocks right now. So this ETF is definitely another one to look at. All right, and now for number 4, we have the Gold Miners ETF. The ticker is GDXJ, and this ETF has a basket of gold mining stocks, and I am very bullish on gold right now. We can take a look at the long-term chart, and what I really want to point out is how gold performs after huge recessions. We can go back to the Great Depression. In 1929, gold was at $307, and 3 to 4 years after that, it was at over $600. So we saw over a double. We can go to the dot-com bubble of 2000, and gold had a low of around $380, and a few years after that, it was up almost at $600 again, and then again during 2008, gold dropped all the way to $865, and just 3 years after that, it was over $1,800. So it usually takes 2 to 3 years for gold to really see an upswing in price after a very large recession. But I think that has a very good chance of happening again, where we have this huge recession and it might be bigger than a lot of people think. And especially with all the money printing that the Federal Reserve is doing, I think gold has the potential to do very well. And over the past number of years, we saw a huge bear market in gold, where gold dropped by a large amount. But I think we're beginning to see that reverse, and gold will continue its move upwards, and that will bring gold mining stocks with it. And so I might actually buy some of this ETF. I don't have much experience with valuing gold mining stocks, so I think I'd rather just buy an ETF to hold a basket of them to benefit from the group performance of gold mining stocks as a whole. I think they have the potential to do very well. Okay, and this is the last one. This is a little bonus I found. This is not an ETF, but it is a closed-end mutual fund. So it acts in a very similar way. It is the Reeves Utility Income Fund, and the ticker to this is UTG. And the manager of this fund is John Bartlett, and he selects utility companies with high returns on equity from expansion projects. And this has proved to be a very good strategy over the past 10 years. It has a dividend yield of 6.5%, and over the past 10 years, they've outperformed the S&P 500. We can take a look at the chart, and it's pretty amazing how a utility fund can outperform all the tech companies and all the FANG stocks that we've seen go up over the past 10 years. This fund manager obviously knows what he's doing, and so I really don't know if there's a reason why this would stop. I think this manager knows what he's doing. He's picking good quality utility companies, which are, as a group, very high quality, and then focusing on the ones with high return on equity, which is something I like to look at when choosing stocks to invest in. But I think that strategy has really worked, and they have a dividend yield that almost matches the average S&P 500 return. So I think that this fund could continue to outperform the market. Since their bottom in 2009, they've been up over 300%, which is a very large increase for utility companies, which are typically thought of as slow companies that pay a large dividend. The difference with this fund is they do pay a large dividend, but they focus on return on equity, which means that the utility companies they'll be investing in are going to be growing faster than average. And I think that's the key to this fund's success. I haven't checked. I don't know the expense ratio. It might be high compared to an ETF, but I think that this could also be something to look into if you're looking for exposure to a specific area like utility companies. So that's it for these 4 to 5 ETFs that I think will beat the market over the next 5 to 10 years. Let me know what you think. Which one of these would you put your money in if you had to choose one? For me, it would probably be the China one. I think the Chinese economy would be a very good place to be invested in right now. So let me know down below. If you learned something from this video, hit the like button, subscribe to the channel, where I come out with videos like this multiple times a week, and I will see you on the next video.